Why do some people retire with financial freedom and others struggle and scrape just to get by, despite making similar income before retiring? This is a question I asked myself about 16 years ago in 2010. I found some answers I want to share with you. Hello, everyone. My name is Brad N. Reed. I would like to encourage you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. Welcome to the series I call Building Your Financial Fountain of Freedom. How do you build streams of tax smart income while growing equity for future generations? I want to build, and I am building for myself and my family, um, streams of income that are going to cover my needs during retirement. Those streams of income are going to continue to grow and outpace inflation. And then I will retire with more money. I will die with more money than I retire with. So I will leave a magnificent financial fountain of freedom, or potentially several financial fountains of freedom to my kids, and hopefully teach them, train them to do maintenance on that financial fountain of freedom so they can pass it down to their kids. Today marks the first episode where we jump into multifamily real estate. So today is going to be about why I love multifamily real estate and why so many other people do. We'll jump into a little bit about due diligence. For those of y'all that know, and for the people that I see in the participant list, they do know. What's up, Sam? Yeah, what due diligence is, it's where you go through and you verify the numbers, you make sure that it's something that you want to invest in. So, what are the steps? How do you do it? That's what we're going to cover today. I am building a four-tier offering. Step one is how to be good. Good, Good, is get out of debt. And then step two is control and align your mind, body, and spirit. You are your mindset. Your mindset determines your future. And so you need to understand your mindset. You need to hack your brain, identify your true self, find your calling, and build the life that you want, not just the life that you're getting. Step three is where we are, invest for success. It's one I call dominate. It's where we learn to invest, build businesses, grow many streams of income, and achieve our financial dreams. And then step four is where you live out those dreams. How do you be a responsible, successful investor and not outspend your income, right? I'm sure we've heard many stories of athletes and artists and all kinds of famous people that had 8, 9, 10 figure wealth and they lost it all. So once you build these financial fountains of freedom, how do you keep it? How do you give generously? How do you make money while you sleep? How do you keep it going so that you can live the life that you have dreamed about and pass it on to your kids? That's what tier four is about. The lawyers out in LA want me to remind you that this is not financial advice, nor is it tax advice, accounting, or legal advice. There will be no offer in this document, in this presentation. There is no offer to buy or sell any security. Should you want any such advice like this, you need to seek a competent and hopefully licensed individual in your area. All right. If I'm still going to go over this again because these are important steps. If you want to build financial freedom, you need to start with your money mindset and your mindset in general about life, about what money is, about what it means. Because your money mindset determines your financial future. Your relationship mindset determines your relationship future.
Mhm.
Your health mindset determines your health future, and so on and so forth. What's up, Bijan? You need to calculate your desired rate of return. Inflation is the scary animal that not even Hollywood's writing movies about. It is that scary. So click on that link, invest.indhrs.com/IARC. IARC stands for Inflation Adjusted Retirement Calculator. I'm putting it there in the chat pane. If you're watching this on YouTube, it'll be in the description. But go over there, use the calculator, and actually calculate what rate of return you need. Then you can structure a portfolio that is full of investments that will allow you to achieve that desired rate of return so you can build your own financial fountain of freedom. Ray Dalio says get investments that are diversified, non-correlated with asymmetric risk reward. Peter Maluk advises to focus on real estate, but definitely focus on private investments because that is where the bulk of the growth is. By the time they become public, like stocks, you've missed the vast majority of the earnings. And also be sure that your portfolio serves your needs for cash on cash and equity growth. If you are unfamiliar with those 3 bullet points, go check out episodes 1, 2, and 3 on YouTube of the Financial Fountain of Freedom. That's where we talked about those. Episode 3 and 3.5, I think, is where we talked about the calculator. Indomitable Horizons Funds has investments now. For the one that we have open right now, you do need to be accredited. Spoiler alert, it is in real estate, multifamily real estate to be specific. Lastly, I'm going to advise you that how we learn is 10% by reading and listening, 30% by discussing with others, and 60% by doing. So just watching this video, listening to me talk, you're only going to get 10% of what you need to build this skill. And you do need a skill to do this. You're going to get 30% of the skill by discussing with others and 60% by actually doing it. So the point is you read, listen, and study. You discuss with others so that while you're doing it, you don't get crushed. All right, well, everyone, hey, Alice. Alice is new to our group. What's going on? Hope you and your family are doing fantastic. I am overdue for reaching out and checking in with you. So the purpose of the Financial Fountain of Freedom is to make you aware of various ways to improve your financial investing skill. And I forgot to update. We are in the multifamily knowledge, so this should be orange down here, not the stock market education. So I will update that slide, but let's jump into it. Why do I like multifamily real estate and so many others? Because it generates cash flow while you are holding it. The whole point is that after you invest, you receive money. You don't have to wait to sell it to get money. You receive money while you're holding it. And one of the one of the most common questions that I get is, "Hey, Brad, if we get into this apartment or we get into this asset or we get into these short-term rentals or whatever it is, what happens if in 5 years, 7 years, when we go to sell it, the market's bad?" Well, it's right there on the screen. We just collect money. We don't have to sell it. It's paying us. It's putting money in our pocket. Usually every quarter, sometimes every month, but heck, if we're not getting the value we want to sell it, we just keep the money from it. It's like if you have a sunflower farm and you like eating sunflower seeds, if you're not getting enough money to sell your farm, well, just keep bringing in the produce. Just keep receiving that income. Put monthly or quarterly income in your pocket, pay your expenses, save up, invest in the next deal, whatever you want to do. It's all about building streams of income. Another thing I like about multifamily real estate, now this one's specific to commercial multifamily real estate, not residential multifamily real estate, but you can force appreciation. Okay, you can make the value of your property go up. You don't have to just wait for the market. You don't have to wait for your neighborhood to go up. You are in control. And I'm going to talk a little bit about that on the next slide. But also, folks, I know a lot of ways to make money. I know a lot of businesses that are out there. I know a lot of jobs that I could have. But folks, this one, we're providing the basic human need of shelter. This is a growing human need here in America and in the world. And there's a lot of people that are not doing this in a quality fashion. I have walked through houses and apartments, and I'm not going to say full hazmat gear, but pretty darn close, right? I'm in my I got a pair of pants that have like a sealant. They're not like jeans, almost like a raincoat as well. Sometimes I wear a hat, I wear a mask, I wear goggles, and I'm going through these houses and these apartments, and there's bugs everywhere. There's trash lining the walls, and there's kids, there's babies in diapers and barefoot living in these conditions. Okay. So I am proud to say that there are 223 housing units that I am responsible for where this does not happen. If the air conditioner goes out, we get it fixed. If there's a hole in the roof, we get it fixed. If there's a neighbor that's hoarding boxes and garbage and creating a rodent or insect infestation, we evict them. We clean the unit, we clean all of the units, and we get a new tenant in there that will live responsibly. So, okay, I'm going long. I want to keep this one short today, but as you can see, I am passionate about the human need of shelter to the point that Bijan and I went down to Costa Rica, where we saw real poverty. We saw people, not just people, entire neighborhoods living in piles of sheet metal, and we and a couple of our multifamily real estate investing friends built a house for a family in need. And when we stood on the roof, uh, Bijan and I were responsible for nailing down the shingles and finishing up the roofing project. As far as we could see, just piles of sheet metal. What was it, Bijan? Five families shared a toilet. I mean, here in America, we look for how many bathrooms are in a house. There, it's how many households share a bathroom. At any rate, shelter is important to me. So, want to talk about how properties are valued and why I really love the multifamily side of this, commercial multifamily side. If you have a residential property, maybe the house you live in, or a single family house that you rent, or even a duplex, triplex, or quad, 4 units and under, your comps, your neighbors determine the value of your house. And I love this tagline AI came up with: your neighbor's neglect is your problem. Because if your neighbors are selling cheap, or if your neighbors are devaluing their property, then your property goes down as well. But on a commercial property, the value of your property is determined entirely by the net operating income divided by the cap rate. The net NOI stands for net operating income. It's basically all of the income that comes in minus only the operating expenses. So if Bijan and I and Alice and Sam, the four of us, we all have apartments side by side by side, and they are exactly identical. But Sam gets better rents for hers because she offers better service. Alice gets lower operating expenses because she is super efficient. And Bijan and I are just kind of slacking it and just collecting whatever comes in. Alice's property and Sam's property are going to sell and be valued higher than Bijan's and mine's property. So when I look for a property I want to buy, I look for that exact scenario. Exactly. I look for properties nearby that are similar, that have a higher expense ratio, or they are bringing in less income. And I want to see that I can take my property and raise the income, lower the expenses, and that raises the value. So, some specific examples of where I have actually done this. It was May, was it May 30th? It was May of 2025. Closed on a 20-unit apartment in Dallas. We bought it for 3.2 million. We raised the rents, we lowered the expenses. 9 months later, it was worth 4.1 million. Okay, $900,000 in about 9 months. Yes, please. In March 30th of 2025, closed on a 29-unit apartment in Cincinnati. We got it for 1.7 million. 9 months later, that one was worth 2.3 million, $600,000 in 6 months. because we look for properties where there's an opportunity to raise the rents. Maybe there's some renovation involved, or maybe the previous owner has just not done it. Maybe there's a couple of problem tenants that are preventing us from raising the rents. But whatever the reason, we can raise the rents, we can lower the expenses, and we increase the value of our properties. That's called forced appreciation. That is awesome. All right, so net operating income is all types of income minus operating expenses. Maybe people are not charging for premium parking or pets, or sometimes we can get deals with cable companies to provide internet and cable services, and we get a group rate, and then we pass on a discounted rate to our tenants, and everybody wins. Cap rate's a little bit harder to explain. Technically, it's the return you earn with no debt. Most people that I know of don't know what that means in real life. So think of it as a multiplier. If we have a market that's a 10 cap, this may be some tertiary market, some towns of 200,000 people, maybe 100,000 people that we might say are kind of out in the middle of nowhere. They've got a couple of stoplights. They've got a McDonald's. And for those places, whatever the net operating income is in a year, if you go to sell it, you're going to get about 10 years worth of net operating income. So if your net operating income is $100,000, that property is probably valued at about $1 million. Now, a 5% cap rate is going to be more towards your major metropolises, Dallas, Miami, Indianapolis is a rapidly growing market, and there's just crazy low cap rates here. I don't get it, but we've got low cap rates. But I do have an apartment in downtown Dallas that is a 5.75% cap rate. And the reason it's not lower, the reason not closer to five, because it is more of a C-class apartment. At any rate, cap rate is the way we look at it as a multiplier. If you are in a really, really strong market like Dallas, Miami, Houston, Indianapolis, some of those big cities, Raleigh, Nashville, you're going to have lower cap rates because it's a very stable market. If you have a really nice apartment, like it's an A-class apartment, maybe a brand new build, that is also going to lower the cap rate versus an apartment that may be 70, 80, 100 years old. Maybe the maintenance or renovations are, behind schedule. That's going to drive your cap rate up as well. So raise rents, cut vacancy, reduce expenses. You get higher net operating income. Higher net operating income means forced appreciation means higher value. So here's an example. If you have a property that is $100,000 of net operating income at a 5% cap rate, that property is worth $2 million. If you can increase that net operating income by $10,000, your new net operating income is $110,000, but now you have $2.2 million of value in your apartment. So whatever you did to increase the revenue or decrease the expenses by $10,000 in a year, you increased the value of your property by $200,000. So this is what we did on the Dallas apartment. This is what we did on the Cincinnati apartment. This is what we did in the Birmingham apartment. This is the strategy that I look for, that I do when I'm doing apartments, because we can force the appreciation. We are in control. Now, demand is not going away for housing. This chart goes back to 1997 and comes up to 2025. And what was happening in the early 2000s is that we overbuilt housing units. But for the last 20 years, the population and the demand for new households has exceeded the supply of housing units. And that includes houses, apartments, whatever people might be living in. And that demand is growing. Okay, the demand is growing. It has not stopped. The demand for housing, think about immigration, think about how Think about how the population of the United States is growing, both from birth rates and immigration. Housing cannot keep up. You know who's responsible for that? You and me. And the government is providing massive incentives because the government needs housing for people. So, a little story about why the commercial multifamily real estate market dipped in 2024, 2025. For a lot of people say, Brad, this is a bad time to buy because the market's down. And I know Bijan, myself, Sam, Cheryl's note taker here, Ian's note taken there. We were all buying because the because the market was down. Why was the market down though? Because in COVID, the government shut down the building of new apartments. So when that COVID ban was lifted, all the builders started going for it at once. Do you remember how building materials spiked and everyone was laughing about the cost of lumber going sky high? It's because everyone started building all at once. When the COVID ban lifted, permits were pulled, and when permits are pulled, it takes about 3 years to get the apartment open. That's why 2024, 2025 had the highest number of new apartments hit the market in 20 years or more. And by the end of 2025, those units were saturated. They were filled. And that's why you got that little blip right there. But the demand is still growing. So if you want to help people with the housing crisis, if you want to call it a crisis, let's invest in multifamily together. Another reason that demand is not going away is that the new kids, the millennials, the youngsters, they don't want to live in a house. They want to be mobile. They think it's exciting to live in a different place every year or even every couple of months. That's why I'm like this portfolio of short-term rentals that we have open because they want to live in a furnished place with high-speed internet. They want to live there for 3 or 6 months, and then they want to move to some other place. They don't want employment. They want contract labor. It's the millennials that are entering the workforce. It's just, I find it shocking and interesting to just see how different they are than how I grew up and how the people before me grew up. So it's not just that the population is growing, it's that the population is shifting away from purchasing and towards renting. And another reason that, oh, do I not have the numbers? Oh, I used to have the numbers. The median monthly payment for a mortgage right now across the US is about $3,000. The median rent for an apartment is about 1,500. So buying a house costs almost double as far as renting. I remember what, 5 years ago, 10 years ago, I would be talking to someone who was renting an apartment, and I was like, you can buy a house for that same monthly payment, right? And then the strategy was, how do we get out of renting into buying a house? Because you could, your mortgage would be about the same as your rent. It's not like that now. So now is a great time to buy some apartments if you get the right areas, and that's what the rest of this series is going to be about, because not all of these areas are the same. If you can get them in the right areas, your demand will be your demand should be fine going forward for years and years and years to come. So we're going to talk more about how to choose the right market. In fact, that'll be the next episode because not all markets are the same. There are some crazy discussions going around in New York about the government taking over apartments. I don't know how they're going to do that, but they're talking about that. Maybe you remember a year or two ago, was it gangs from, oh, I don't want to put the wrong country under the bus, but there was gangs from other countries that were coming over, taking over apartments and collecting months, and the landlords still had to pay their insurance. The owners still had to pay their mortgage. The government didn't do anything about it for weeks. Want to stay away from crazy government cities, in my opinion. I like investing in cities that are landlord friendly, as we say. Okay, demand is not going away. And because of that, the government is offering us incentives. Disclaimer, Folks, pay attention to this. I am not a CPA. I'm not a tax attorney. I am not a tax expert. I am a reporter and a bad one at that. Okay. I hire people to do all of this stuff for me. So I'm going to talk about some high level concepts. You need to understand what it means for you based on whether or not you are a real estate professional, if you're full time, if you're part time, what city and state you live in, what city and state your property is in. You need to talk to an accountant about your very specific situation to see which, if any of these, apply to you. Okay, depreciation. All this means is that when you buy a property, the government says, hey, we know your stuff is going to wear out. Your roof is going to wear out. Your AC is going to wear out. The light switch on the wall is going to wear out. If you, and basically everything is going to wear out over 27 years and you're going to have to replace it. So the government allows you, in some instances, to deduct this from your taxes. Ask your CPA on how you can do it. But this is one reason why the wealthiest families have the majority, excuse me, not the majority, they have the bulk of their investments in real estate because they like depreciation. They like the tax benefits. You may have heard something called a 1031 exchange. This is if you have an investment, particularly a real estate investment, and you sell it, you can avoid paying taxes on the gains, if I'm saying this correctly, and I'm probably not, if you roll that money into another investment under certain criteria within a certain amount of time. Okay. You there are families that have avoided paying taxes for decades, sometimes entire generations. Because what some families like to do is that the oldest generation keeps investing in properties, and when one sells, they immediately turn around and buy another, and they don't have to pay any taxes in a certain category. I believe it's capital gains taxes. And then when they die, the uh, their inheritance gets passed on. What is it? The inheritors, whoever inherits those properties, the taxes is wiped out, and they inherit those properties on a stepped up tax basis to the heirs. Thank you. So the point is 1031 exchange, you can avoid paying some taxes for a very, very, very long time, possibly ever. And then there's a new one right now that Trump has recently passed. I say recent, I guess several months ago, um, where you can take a massive chunk of depreciation right up front, called a cost segregation study. Doesn't apply to everyone, doesn't apply to every property. Not every operator chooses to do this, but you, yeah, you can take a really big chunk right up front. So a lot of people are calling this a poor man's 1031 exchange because the 1031 exchange has some rules, it has some regulations, and it has some fees involved. But if I sell an apartment and I receive a big chunk, I can pay the capital gains on that. I can go invest in another one, get a cost segregation study, take the advanced depreciation or the accelerated depreciation, excuse me, and then use that to counter the capital gains tax that I received on the other one. Now, I'm not saying this right. So if this sounds confusing, I'm not saying it right. And sometimes I'm purposely not saying it right because I'm not an expert. My point is that there are tax advantages for investing in multifamily real estate. Talk to your CPA, get your tax advantages. The reason we have the tax advantages, don't feel guilty about taking them because the government, the Americans in our society, they need us to provide quality places to live. It is needed. If you complain about the cost of living, do something about it. Create more places for people to live. That's what Bijan and I are doing. All right. How do you know if it's a good deal? The last year, I got to tell you, has been completely eye-opening and a little bit soul-crushing because as I have been stepping up my hunt for properties, since Bijan and I opened this fund, we have gotten flooded with deals. Easily, oh gosh, I was going to say 100 in the last year, but it's probably been 100 in the last couple of months. While I was on vacation, I got three. um, and they're coming to us. Here's the problem. There's some really good salespeople out there. I know people that have several hundreds of millions of dollars worth of apartments. They call it assets under management, and they have hundreds, thousands of doors, and they are complete scumbags. They're really good salespeople. So how do you know if something's a good deal or not? Bijan and I have a process we call MURAL, MURAL. And the idea is that we go through this filter, and then whatever passes the filter, we invest in. And then through the fund, you can actually choose which of the investments that have passed our filter you want to invest in. And you can choose how much. So it's like painting your own mural of investments. It's like building your own financial fountain of freedom of investments that have already passed our filter. So through the next several episodes, I want to teach you our filter, and so that you can do this for yourself. And then you don't have to take our word for it. You can go and determine if this matches your criteria. So first of all, we start off with market analysis. That's M. So is this a good market to have an apartment in? We're going to talk about how to look. Are there apartments for sale already in this area? What's the cap rate in this area? What's the population doing? Is it growing or declining? Is there a big gap between buying a house and renting an apartment? What's crime doing? Is crime going up? Is it down? Is it a high crime area? Is it a low crime area? What about the labor market? Is the labor market growing? Is unemployment going down? Is there a good diverse mix of jobs in the area, or is it dominated by one industry, which means one competitor, one government regulation, and that whole town could be wiped out? For instance, anybody heard of Monahans, Texas? Anybody? Monahans, Texas. I'll put it in the chat pane. You can go look it up. Oops, wrong cursor. Monahans, Texas. I got pitched a great deal out in Monahans, Texas. Monahans is an oil field. There is one economy in that town, and it is oil. And so I said, you know what? No, thank you. Because if there is a change in the oil market or in this particular oil market or whatever, my whole apartment goes away. I'm not taking that risk. So M is for market analysis. Check out Monahans, Texas, if you want a good time. I'm I'm not even sure. I think they do have a stoplight, but it may be one stoplight, literally. Oh, another one, Inyakern, California. I went there. Big military base there. Population of 473. I kid you not. When we landed, a rabbit ran across the runway, just like in the movies. Baggage claim was one of those 8x4 folding leg tables where they just pop up a table and they take your bag out from under. Yeah, I'm not investing in an apartment in Inyakern, California either. Okay, underwriting. This is all the math, yay spreadsheets. You know what? Hooray for artificial intelligence because it has completely changed underwriting. But what a lot of people forget to underwrite are the operators. One of my new favorite sayings, I hope you've heard me say this, a great operator can save a bad deal. A bad operator can tank a great deal. I have a huge respect for new operators, for good operators that have experience. Bijan, help me out if I leave one out. Things Bijan and I have discovered over the last year. An operator that was, I thought, going to be my new best friend is getting sued for misrepresentation on a deal. Promised everyone a deal as a fixed rate deal at the last minute, like a day before closing, switched it to a bridge loan, closed without telling the investors. Interest rate spiked. The deal went negative. Yeah, there's another one. Again, thought was going to be my new best friend. Turned out had an arrest record in multiple countries. Just one more. One had a great fund, had a revenue generating model that Bijan and I were actually exploring. How do we do this ourselves? Uh, Turns out they've been banned from FINRA. They've been banned by the government. Um, what else? People brand spanking new, never done one before, taking on hundreds of millions, hundred, no, that's an exaggeration. Hundreds of thousands of dollars, seven, eight figures in investment money. Never operated an apartment before, ever. All right. Do not let your money be someone else's learning curve. All right. I'm venting right now. Just some of the stuff gets me really fired up, y'all, which, I hope you know this is why I'm doing this series, is that there's a lot of people not doing this right. And I want to help you avoid some of the painful mistakes that I've made. All right. Risk analysis. I just recorded a video on this on a property that we are raising money on about what could go wrong, what happens when it does, and what's the plan to fix it. Every deal has risk. Every investment has risk. Know before you invest. I have a buddy that had two apartments that burned down to the ground. He did have insurance on one of them. Everyone got pretty much their entire seed money back, but nothing else. The other one, it was in one of those cities that I, you know, was kind of hinting at that's not landlord friendly. Made them chop up the remains into small pieces that could fit into a 30-gallon trash bag. They had to bag everything up in hazmat bags, put it on a flatbed truck, and haul it off to a hazmat storage facility. The investors lost almost everything. One deal, plenty of deals that I have seen, they do not have a landlord policy. Folks, there's an insurance policy called a landlord policy. And if for some reason the property gets damaged, then that insurance policy replaces the income. I'm not saying that's what's needed on every deal, but know your risk analysis and know the mitigation plan that the operator has ready to go. One cool thing about the deal that Bijan and I are raising for now, it's a portfolio. So if any one property gets obliterated, gets burned down, gets hit by hurricane, there's an entire portfolio to keep making money. And yes, we have landlord policies. Alignment. Oh my gosh, this is one that I've caught a lot of people doing. Does the operator make money with you or from you? We're going to go into something. There's something called carve outs, and the carve out is how the operators get paid. There was a team that wanted me to come on board with them, and they were getting 5 to 7% acquisition fees right up front. Typical acquisition fee is anywhere from 1 to 3%, and it basically covers the operator's work, which, folks, there's easily 9 months of work, definitely 3 months just to close it. But it's a lot of hours from a lot of people. But they were charging 5 to 7% acquisition fee and nothing to sell it. So they made all their money up front and then they went off to get the next deal. They did not care whether their investors made money or not. So again, we're going to talk about alignment. Does the operator make money when the investor makes money? And then legal. What legal structures are used by the operators? You need to know the difference between a joint venture, a 506B syndication, a 506C syndication, Regulation A, Regulation D. Can you invest with it in a 401k, in an IRA, in a Roth IRA, in a self-directed IRA, in a self-directed 401k? Do you need a LLC for yourself? Does the operating team need an LLC? Did I say joint venture? There's a lot of legal stuff here. And I'm not going to pretend to be the lawyer. I'm going to make you aware of what kind of stuff is out there. I will let you know that our fund, here, I'll type this one in the chat pane too. Regulation D, 506C, 3C, 5C. Go look that up, have fun. That is the structure, the legal structure of our fund. And basically what that means is that securities that are offered through the Regulation D 506C exemption, we can invest in. And when you invest through our fund, and we bring that into our fund, then you can choose your own allocation and you get rights to our shares. So what does that mean? That means we can filter, we can invest, and you build your portfolio with what has passed through our filter. So I want you to spend the time, spend the energy to understand the filter, how the filter works, how market analysis works, how underwriting works. How do you go and check the operators? What kind of risk analysis has been done? What risk analysis needs to be done? Is your success aligned with the operator's success? And is everything legally set up to be able to operate and go forward? Because if it's not, we don't want to do it. And if we go through and we do this entire filtering process and you want to invest in something that we've already filtered, I want you to go do the underwriting and come back and say, bro, did you see the risk analysis? Looked a little light to me. Maybe I saw something you didn't. Maybe you saw something I didn't. But let's all work together. Let's work as a team. And this is what is the plan going forward. Looks like we're going to wrap this all up end of October. Today talked about why multifamily, why I like forced appreciation, because I have control over the valuation. And I've talked a little bit about the portfolio that Bijan and I are raising for right now. There's already been 40% forced depreciation on this portfolio. We got rezoned and we got a resort up and running. So what is a $5 million syndication is currently valued a little over $7 million. So new investors, they get 40% unrealized equity on day one. July 25th, we're going to talk about market analysis, all of that stuff. That one's going to be a long episode. If you bring your markets, if you bring me cities, I will do your city live on the recording. So Alice, Dad, Sam, Cheryl, Ian, whoever else is out there, if you come live on July 15th, excuse me, July 15th, bring your city, type it in the chat pane. I will analyze it for you. Spoiler alert, I'm analyzing it for me too, because I have a bunch in a spreadsheet that I keep. And then July 29th, we're going to talk a little bit about operator vetting, how to determine if you have a good operator or great operator, and what are the risks and what are the differences. 2 weeks to get through all of the underwriting. There's a lot of spreadsheet work, folks, but it's worth it. And after you do it, like the first couple of times I would do one of these spreadsheets, it took me about 2 or 3 hours to do one. Now it takes me 10, maybe 20 minutes. Then we'll talk about risk analysis. Anybody heard of FMEA, failure modes effects analysis? I did that for a decade or more when I was a Lean Six Sigma Master Black Belt. That's a lot of how I saved that $850 million in process improvements and problem solving. It wasn't just about solving the problem. It was about making sure that that problem stays solved. So we would look at what are the potential failure modes of the new process, what are the effects, how do we know if it happened, and how can we analyze that and mitigate those risks. Then we're going to come to A of MURAL for alignment, and how do we know that the operators are getting paid the same way that investors are getting paid, or sorry, not the same how, but on the same situations. And then we'll talk about legal structures. And then looks like October 21st, if we stay on track, putting it all together, how to read a deal. Maybe we'll go through some operating memorandums and go from start to finish, underwriting a deal. I just said I could do it in 20 minutes. Bijan, you may have to help me on this one. October 21st, here's the challenge. We're going to do the entire MURAL process in an hour. Who's up for that? If you are watching this video and you are wondering how to come live, check the description in YouTube. There will be a link on how to register and come live, like Alice, Cheryl, Ian, my dad, Sam, Bijan, and other people that have come in the past. All right, folks, don't forget the end goal. The end goal of this is not just to get an apartment. For God's sakes, I know a lot of people lately who have gotten excited about buying apartments and they just buy any darn apartment they can find. And they're getting into horrible deals with horrible operators. And then they call me 3 months later, 6 months later, and say, oh my God, how do I get out of this? I guess I didn't talk about this enough, and we need to. So I'm going to talk about it now. Most of these deals are a 5 year, 5 year lockup period. Some of them 7, some of them are 10. You got to do this due diligence because if you get into a crappy deal, you just can't get out at the drop of a hat. I know some people that just got into a deal and found out that the operator got the legal structures wrong. The illegal legal structure after they had invested hundreds of thousands of dollars. Because I think the minimum on that one was like 250, 275. You got to know the operators that you're getting in with, and you got to know the okay, I'm rambling. Money mindset determines your financial future. So get control of your mindset, learn your mindset, calculate your desired rate of return. If you see a deal and you love the deal and you love the operator, but it falls way short of your desired rate of return, are you sure you want to do it? What if it's like way over your desired rate of return and it's super risky? I took one of those. If y'all haven't heard about my paving business, it was a 4x multiplier over 5 years. That is, I don't remember the annualized rate of return, but it's in the 40s or 50s. The operator got sick and quit. And fortunately, I'm getting all my money back, but I'm not getting any growth. Don't take risk you don't need. How about that one? If it's don't take risk you don't need. Use the calculator, calculate the desired rate of return. Everyone here, if you haven't done that yet and you want to sit down and do it together, y'all all have my cell number. Text me. I will go through it with you and your spouse or your accountability partner or whatever your situation is. Structure a great portfolio that is full of investments that are diversified, non-correlated, asymmetric risk reward. Bijan and I are raising for a deal right now that is all 3 of these things in one investment. And it is a real estate deal. So get diversified, non-correlated, asymmetric risk reward in different asset classes that serves your need for cash on cash and equity growth. Spoiler alert, the portfolio we have right now has tremendous cash on cash and equity growth. It is truly a unicorn. That's why Bijan and I keep putting more of our own money into it. Dominable Horizons has that investment that I talked about now. Don't forget, folks, you are only going to get 10% of this skill by reading, listening, and watching these videos. So if you have questions, I'm about to wrap up. Type them in the chat pane. Alice, if there's anything you want to share about yourself, share it with us now in the chat pane. Ask questions because I'm almost done. You will learn skills 30% by discussing with others, 60% by doing. And connect with me on social media. If you want to reach out, if you want to ask me questions, you ask me about deals, ask me about what I'm up to. That's how you can connect with me. All right, folks, if you can't tell, I am amped up and I am excited about multifamily real estate because I've seen what it has done for me and my family. I'm excited for it to do similar things for your family. I've seen what it's done to Bijan's family. I know what it's done to Deanna's family. I've seen what my dad's gotten into some multifamily, no, not multifamily, single family real estate. Cheryl, I know, has done it. Ian's done it. Sam's got a bunch. It's awesome. It can be life-changing, not just for you, but those that come after you. All right. I am excited. I'm going to make myself shut up. So I'm just going to say, folks, thanks for joining with me this time. I will see you again in 2 weeks. Do not hesitate to reach out in between time. And as always, invest on logic, not on hope. God bless you.